Okay, good afternoon, everyone. Thanks for joining us for another one of our WESK webinars. My name is Josie, and I am WESK's Marketing Advisor. For those who aren't familiar with WESK, we are a nonprofit organization focused on helping female entrepreneurs to both start and grow their businesses. We offer a variety of different services, including business advising, financing, events, and training. Right now, we're offering free webinars every Wednesday on a variety of different business topics. And for the month of October, all of our Wednesday webinars are accounting focused and are offered in partnership with our friends at Deloitte. So our second topic of our Deloitte Learning Series today is Financial Statements 101 and is presented by Josh Stranden, Senior Accountant at Deloitte. If you have any questions during the presentation, please make sure to use that Q&A box at the bottom of your screen, not the regular chat box. And I will let Josh decide if he'd like to answer these questions kind of as we go through the webinar or at the end of the presentation. As always, this webinar will be recorded and will be available for on-demand viewing. And you'll receive an email tomorrow at about this time with a link to that recording. So keep an eye out for that. Okay, with that, I think we are ready to go. Josh, I'll hand it over to you now, and please begin whenever you're ready.
Wonderful. Thanks a lot, Josie, for that introduction. So I'm just going to get my slides set up here for us. So just give me 1 second. Okay, perfect. So as Josie said, I'm a senior accountant in our Saskatoon office here at Deloitte. I specifically work in audit private. And I have the pleasure of being here with you today to talk about Financial Statements 101. So this is something that I like to consider myself not necessarily an expert in, but I do know 1 or 2 things about it. So really, when it comes to financial statements, this is the end goal of a lot of your bookkeeping that you will do kind of throughout the year to keep track of revenues, expenses, and your balance sheet items such as assets and liabilities. So this is really your end goal kind of at the end of every year, or some companies choose to make financial statements monthly, quarterly, to keep updates on kind of where the business is at. Bookkeeping at its very basics is really is telling you really where your money is, where it's going, and when it's going to come in. So really, I can't really undervalue how valuable keeping good books is, and the benefits that the year-end or month-end financial statements will really give you. So jumping into kind of our first little bit here is really telling you what financial statements are at a high level, and they're really made up of 4 main components. The first component being the balance sheet, which keeps track of all of your assets and liabilities. Some examples of assets are cash, investments, property, plant, and equipment, buildings, whatever it is you might have. And liabilities are things that are usually outgoing, such as, accounts payable, other liabilities related to deferred revenue, and there's a few other examples. We'll get into them a little bit later in the presentation. The statement of cash flows is a little bit of a different statement, and usually one of the more complex statements that we'll focus on a little bit at the end of the presentation here. And really what the statement of cash flows is showing is it takes your opening cash balances at the beginning of every year. So these are the balances that you'll find on your January 1 bank statements if you're on a fiscal year end. And then it shows you all the way to the end of the year exactly how the cash was spent. So it's probably one of the more valuable statements that you'll find keeping track of, as it will really show you exactly how your cash position has changed from 1 month to another, or from the beginning of the year to the end of the year. And then your last kind of component of your financial statements is your notes to the financial statements. So how we usually like to explain these is these are really telling the story behind the numbers that you'll see on your financial statements. So a lot of times what's included in the notes to the financial statements are things, explaining exactly what your revenue is made up of, all the way down to, what kinds of property, plant, and equipment you have on your balance sheet. Moving on to kind of our first part where we'll start is we'll really start with the income statement. You'll also hear this referred to as the statement of operations. And really I'm going to kind of, I'm going to use the income statement as the terminology because that's usually what new business owners will call their financial statements. The only differentiation from one terminology to the other is the accounting framework chosen. For most entrepreneurs, most startup businesses, the framework of choice is usually ASPE, and the terminology used in ASPE is income statement, balance sheet. So as you grow, there will be options to move through different frameworks, but for the most part, we're going to focus on ASPE today. So components of really what makes up the income statement, some of the most important are the revenues and expenses. And these are increases or decreases in economic resources. So when you sell whatever it is that you are in the business of selling, those are usually referred to as increases in economic resources. So when somebody's paying you for service, if you're a carpet cleaner, when somebody gives you cash for the service that you've just rendered, those are increases in economic resources that will be recorded on your income statement as revenues. Expenditures are just the opposite of that. What did it cost you to do that business? Usually, there's cleaning supplies that go along with it, the machine that you've used, the water that you've used. Those are your decreases in economic resources. And then at the end of the year, really the number that, most entrepreneurs are always kind of interested in is the excess or deficiency of revenue over expenses. And this is what you'll often hear referred to as net income or net loss throughout the year. So if you have a positive value, you have net income, which is where you've collected more revenue than you've ended up spending. Often that's what our goal is. That's where we want to see, all of you business owners move towards. But normally in the first few years of operations, we see the opposite, where spent more money than was taken in. And this is often the case, not necessarily negatively looked upon, but this is often the case where new business owners are starting a business, you're growing your clientele, you're buying plenty of assets, you're really working to build up kind of, your business. So this is often where, we'll see you start as kind of in the negative net income. And then there's the kind of a final component here, which is the net assets. And this is often a confusing part for many individuals. It took me, 2-3 years of accounting school to actually wrap my head around exactly how this statement works. And really it is the increase or decrease in your net assets at the beginning of the year is accumulated every year going forward, which you'll end up seeing in retained earnings on your balance sheet. So it's really important that, our goal is to have positive balances in our accumulation of revenue over expenses. Moving on, I've put in an example of an income statement here because I feel like me talking about it doesn't necessarily do it justice. Now, this is a bit of a complex income statement. Many of you will not have an income statement that looks necessarily this busy, but usually the more detail in your income statement, the better, is kind of the rule of thumb. So as you can see at the top of this one, this is an example company that we've used many years in training. And I've pulled it kind of in here because I think it does a good job of outlining kind of a few key concepts. Really the top line there, your revenues. This is a car company, so they sell trucks, cars, minivans. Those are really the selling prices that they would have sold those assets for. The cost of sales, this is really going to be dependent on what kind of business you're in. So if you're a tech-focused business, your cost of sales is often going to be actually quite low because your cost of making whatever the product is that you're selling is actually quite low in a technology company versus a manufacturer where you have all the costs to develop, whatever the product is that you're making. You think of a car, for example, the cost for a dealership to buy a car is quite high. Therefore, this company's cost of sales is quite high. Operating expenses are really everything else that you would have incurred throughout the year that aren't directly related to generating revenue. So these are things such as salaries and wages, electricity, all your utilities that you might incur, property taxes, professional fees, so on. And then you can see all the way at the bottom of this statement here, you have your final net earnings. So this company was good enough to be in a positive net income position at the end of the year. Revenues and expenses, often there's, a handful of general questions to kind of ask when you're putting together your revenue and expenses or your income statement. And a lot of these relate to, are there any new lines of businesses? So this is really a revenue focused question. And if they are, do they make sense to be added to your financial statement? So really what that's focusing on is under financial statement preparation, you'll need to break out any lines of business that are specifically different from one another. So if you are a technology company and you are selling software, but you are also selling hardware as a business, those would be seen as two different kind of lines of business unless they are directly correlated with one another. And what I mean by that is you need the hardware to be able to operate the software. If that's not the case for you and you're selling two very separate products, a software and a hardware that don't need to be used in conjunction, then a lot of times they will need to be presented separately on the income statement. So kind of a key point I can make there is if you feel like you have 3 or 4 different lines of business that are generating revenue that aren't directly correlated, put them as separate lines under the revenue heading on your income statement. And when you do kind of get to a point, somebody might question you and say, are they all really separate? And that's when you can start consolidating. It's a lot easier to consolidate all of your revenue lines rather than try and break them out after the fact. Second kind of question that we usually prompt is, are there any revenue and expenses that make sense to the knowledge of the organization's operations? The example that we've put here is paying property taxes, but don't actually own land or buildings. So this is very common in a lot of businesses. And what this is really focused on is actually personal expenses being within your business income statement. So a lot of times, the most common one that we'll see is vehicle operating expenses when the company doesn't actually own a vehicle. And what that's usually indicative of is there is an cost being associated with the company that aren't actually related to the company. So it won't have a huge impact necessarily on your financial statements, but it's good to understand what's business operations versus what your personal expenses incurred are. And where that will actually come into play more is we have a webinar coming up in a couple of weeks that's really focused on tax. And this specifically item will have very different tax effects on you if you start including personal expenses in your business. So just kind of a caveat to a future presentation that's coming up. And then why is accounted increased or decreased significantly compared to a budget? So very important, you know, as a new business owner to always operate or try to operate as close to a budget as you can. And it's always good to take your financial statements at the end of the year and compare all of those amounts to your budget. So if you saw revenue was 10% higher than what you had originally budgeted, that would be a good thing to understand, to know how can we do that again next year and again the year following. And on the opposite side of that too, if your revenue is 10% lower than expected, why was it 10% lower? What can we do to actually get up to our budgeted amount? So that's, you know, where a real use of the financial statements can come in for your revenues and expenses. The next kind of piece that we're going to kind of move along onto here is the assets and kind of liabilities portion. So this is the balance sheet, again, also referred to as the statement of financial position. And this is a statement that is prepared annually, same with the income statement. However, this one's a little bit different. And I didn't mention this on the income statement, but the income statement's prepared basically from zero every year. All of your account balances are zero. Revenue is zero at the beginning of the year. All your expenses are zero. Whereas the balance sheet actually rolls every year. So at the end of your, let's say at the end of 2020, you had $10 of cash. When you come back on the first day of 2021, your income, or your balance sheet rather, will also show $10 worth of cash. And the reason for that is that your balance sheet is showing assets and liabilities that don't necessarily disappear or reappear every year, such as they would in the income statement. The really key piece in the balance sheet is that your assets always has to equal your liabilities and net assets. So often how this will happen is you will have, you know, $10 worth of assets, $5 worth of liabilities, and $5 worth of equity or net assets. What can end up happening is you can have $10 worth of assets, $11 worth of liabilities, and a negative net asset balance. We're going to get into that a little bit more kind of as we work through the slides here, but I'll tell you the difference between what a positive net assets and a negative net assets is really focused on. So we'll start off by kind of talking about assets. They're a little bit easier to understand. Assets and liabilities are easier to understand than the net assets portion necessarily. So if we have questions about that, I would be glad to answer as many as I can. But the assets specifically are usually broken into two types. So there's either current or there's long-term assets. Current assets are usually the assets that are expected to be turned into cash with the benefit received from it within the year. So cash is always going to be a current asset because it is really the definition of what a current asset is. It's something that can be turned into cash. Cash is already cash. And then you can receive the benefit from it right away. So really you could use cash whenever you want. I'm going to skip through a few of these, but another one is inventories. Usually you would expect to sell all of your inventory within the year. Again, if you're a technology company, you probably won't have inventory on your balance sheet. But you might have other larger, technological assets that may exist. But for inventories, normally you would expect to sell all your inventory every year by the end of the year. So again, classified as a current asset. Long-term assets are usually referred to as anything where the benefit will not be received within the year. So these are items where in our car company kind of example in the income statement there, this wouldn't necessarily be the cars themselves because they plan on selling the car every year. Therefore, it would be classified as inventory as a current asset. However, they operate within a building on a certain piece of land that they use for their dealership. Those buildings and land probably aren't going to be used up within the year, have their benefit rather used up within the year. You think of your own house, you don't buy a house planning to replace it at the end of the year. Therefore, those are items that will be classified as long-term assets. A lot of times what you'll see here, if you're a manufacturing company, you'll see, your manufacturing plant, any of your equipment. If you are a technology company, a lot of times what you'll see here is technological assets again, being classified as a long-term asset because you expect to get more than a year's worth of use out of it. An example kind of as a balance sheet for assets here is we have the assets valued, the current assets, kind of all the ones that were on the previous slide again show up here just with dollar values put beside them. So you can kind of see how the current assets are broken out, and then there's a subtotal there, and then very specifically below are two items that would be considered long-term assets. So there you have your property, plant, and equipment, and an investment in ABC company, which we're not going to go into that. That's a little bit more complex than what we're trying to get at here. Liabilities are kind of the opposite of what your assets are. So there's, again, current and long-term assets, or long-term liabilities, rather. And these are items that are expected to be paid off within a year. So a lot of times what ends up being classified as liabilities is items such as accounts payable, which is probably the most common one, taxes payable, or any other expense that you expect to outlay cash for within the year. Long-term, on the flip side of that, are often items that will be continued to be owed for more than a year. So often what you'll see in the long-term liabilities is usually loans payable or notes payable. A very key kind of idea I want to highlight here is a lot of businesses start with a loan or some kind of borrowing to kind of get the feet wet and get going. And an important distinction here is if you have payments due within a year, you will actually have the payment due within the year in the current section, and you will have the payment due outside of 1 year in the long-term section. So if you have a loan for $100,000 and $10,000 of that is due this year, that will be classified as current, and your other $90,000 will be classified as long-term. So a lot of times here you'll see actually two lines that say the exact same thing, loan payable, except one portion will be in the current, one portion will be in the long-term. Just kind of a little add there. An example of a balance sheet for liabilities, you can kind of ignore the very bottom there, that shareholders equity bit. But again, you can see here your current liabilities and your long-term liabilities split out between current and long-term. Under your current liabilities, the very last line there, your current portion of long-term debt. This is an important one that I kind of just talked about, where you have current portion of long-term debt and you also have long-term debt. So those two amounts together are your actual loan payable, whereas having them split out is showing what's currently due and what's due in the future. Breaking these out might seem like a nuisance, and it normally kind of is, but it's really important to do so to understand exactly what you are expecting to pay within the year versus outside of 1 year. And often banks will look at that, take that into account very differently. So if you do have more current versus long-term debt, then you're expecting to pay more in the current year than you would in future years. So net assets, or also referred to as shareholder equity, is really the difference between your assets and your liabilities to get your final net assets. This number can be positive or negative. The goal is always to have the value positive. What that reflects is that you have more assets than you do liabilities. And after the explanation just kind of posed, you would always want to have more assets than you do liabilities. In some cases, this isn't always going to be, the first year of operations, you're going to be able to do that because often taking on loans, using your cash to invest and build your business will often take away from being able to achieve the positive value. But the end goal is really to work towards gaining a positive value in your net assets. This is equivalent to equity in a profit-oriented company. So you're all entrepreneurs, you're all working to make a profit. And so a lot of times what you'll see it referred to on the financial statements is equity. I'll go back one slide here and we can see that on this statement here as an example, shareholders' equity is, an equity account. Kind of giving a little bit more of an example to this, you have assets, you have $100 worth of cash, a liability of a bill payable, say for some services that you purchased. You will have, at the end of the year, if everything else is the same, you will have $40 worth of equity. If the exact same example, you have $100 cash and $120 bills payable, you'll have a deficiency of $20. Now, all that necessarily means is that you have more liabilities than you do assets. And your goal at the end of the day will be to work towards positive net assets. Again, here's kind of the same example, pulling back in that shareholders' equity account to show you exactly what it's normally made up of. I'll make one distinction on this slide. Common shares, preferred shares versus the retained earnings balance, which is actually the biggest balance in your shareholders' equity. Your share capital is what you actually put into the company to start. So if you're sitting, watching me right now saying, I've put in $10,000 into my business, your share capital line will actually reflect $10,000 invested because that is a $10,000 increase in the net assets of your business that will usually be reflected in cash. So most people give the business, cash to get it started. And then your retained earnings is actually the accumulation. So you can see last year there it was 1.02 million. This year it's 1.855 million. That's actually the accumulation of all of your net incomes over the course of your business's operations from day one through day now. The only way that retained earnings decreases is if you pay dividends out of retained earnings. So I'm sure that you've probably heard of, paying dividends versus a salary kind of leading up to this. But a lot of that will probably be focused on in your tax kind of webinar that's coming up in a few weeks. So I won't get into that too much. If you have questions, of course, pose them my way. The statement that I kind of talked about at the start of this presentation, explaining as one of the more complex statements, but also probably one of the most valuable statements, is the statement of cash flows. And really the objective, again, is to show where and how your cash was used. And the statement of cash flows breaks it out into three very specific areas of operations. So your first kind of area is always operations, or operating rather. And what that's really focused on is your day-to-day business. So these are increases or decreases in cash that have happened from you selling your products that you are bringing to the market, or also your expenses. that are incurred in normal operations. Your investing activities, which is the second kind of category, is cash received or dispersed from investing. It includes buying and selling investments or assets. So at its very base, what investing really is it's buying any of those assets that aren't expensed in the period, but rather shown on your balance sheet. And what that kind of is focused on is if you buy a piece of land, say, for $50,000, you're actually investing in that piece of land because you expect it to last for more than a year and have future benefits for you. That's an example of an investing activity rather than an operating activity where you're paying somebody's salary to develop whatever your product is. Financing, again, is very similar to kind of investing, just kind of the opposite of what investing is. So the cash received or repaid from financing operations. So this includes proceeds from loans or long-term debts. So a lot of times financing activities will be if you've loaned the company money, you'll have a shareholder's loan. If you have received a loan from the bank, you will have that as an increase in cash. And when you repay it every period, that will be actually a decrease in cash. So keeping kind of the way the cash flow is going straight is sometimes confusing. But if you are buying assets, you'll actually have a negative investing cash activity. Whereas if you are receiving a loan, you will have a positive financing cash activity. Very kind of important to keep those straight. We go into operating activities a little bit more here because this is the one that you'll probably deal in the most. Going kind of back up here, investing and financing activities you'll often see only show up once or twice kind of throughout the year, as you often repay loans, once throughout the year, or maybe you've received a loan once or twice throughout the year. Same goes for purchasing assets. A lot of times you only make big investments in assets 1 or 2 times a year. Not too much. So moving into operations here, excuse me. The excess of revenue over expenses, or vice versa, expenses over revenues, starts at the very top of your cash flow. So now you're probably thinking, well, put the brakes on. You told me that we're trying to figure out, beginning cash to ending cash, which was on the balance sheet, and now we're starting with the income statement. But actually, the income statement really is going to start by showing you how much revenue and expense you had throughout the year, which theoretically should be convertible to cash. So the logic there is if you sell $10 worth of products and it cost you $5 to make it, you have $5 worth of net income. Working backwards, that $5 should be cash because you have received $10 from the customer, you paid $5 for whatever services it is that you needed, and then you have $5 left in cash. Now that's a very simplistic example of how the balance sheet and income statement necessarily work. But I think it provides a good baseline to kind of what we're trying to achieve by starting with net income. And then you'll make adjustments for things that are non-cash. So items like amortization is probably the most common adjustment that will have to be made. And what amortization really is it's the slight reduction in your property, plant, and equipment every single year. You might also hear this referred to as depreciation, a term that a lot of us are probably a lot more familiar with. And what depreciation really is if you think of your own car, when you bought it, it's not worth the same dollar today as it was, it's not worth the same dollar today that it was when you bought it. And what that difference really is depreciation. So every year you will record depreciation on your assets to decrease them and bring them down to, really, your goal is to get it as close to fair value as possible. And then what that effectively does is it reduces your asset value, increases your expense. The key missing in that transaction is there's no cash impact on amortization. So when you make adjustments like that, you will have to remove them or add them back to your net income or loss to really get that net income or loss back to a cash basis. You will also have items such as changes in non-working capital. These are really any short-term changes in the balance sheet that will adjust your cash flow. So things such as, I use an example as your change in AR. Really, your change in AR is coming from not collecting as much cash as you have in the past. So I'm going to use the example of $1,000 versus $1,500. $1,000 being your current AR, $1,500 being your prior year AR. If you have moved down to $1,000 from $1,500, you've actually collected $500 more cash than you did last year. So at the end of the year last year, you had $1,500 outstanding, and this year you only have $1,000. So you've actually done better. You've collected $500 more dollars than you did last year. What that would do is that would actually increase your cash balance in your working capital values throughout the year. So I won't spend too much more time on that, but I'm sure there's quite a few questions about the cash flow. So let's be sure to take those up kind of in the question period if anyone's concerned about putting this one together. Other cash flow items are really, these are kind of the high levels. Net increases or decreases in cash at the end of the year. You'll be able to tell right away from kind of looking at your bank statements. If it's positive, it means you have took more cash in during the year than was used. So if your cash balance has increased, you've taken more cash in than you used. And on the flip side to that, the reduction is you've used more cash than you've taken in. Should not all be seen as negative, though, is really key here. A lot of times when people look at the cash flow and they see a large dip, there isn't necessarily a focus on why it was a dip, or I shouldn't say that. There's a focus more on why it was a dip versus it just being a decrease in cash. And a lot of times what that focuses on is if you look at the cash flow, cash has decreased this year. However, your investing activities was actually a positive value, meaning that you have, I've said that backwards now. If your investing activity is a negative, leading to kind of your bottom line, changing cash being negative, what that's showing is that you've used cash to invest in either assets or investments, which is often seen as a good sign, actually, because it proves that you're investing in assets that are going to have future usefulness to your business. So if you're a manufacturer and you have in the current year purchased $1 million worth of equipment, you would expect cash to decrease by $1 million, which you might say, oh, your cash is down. That's not a good sign. Not necessarily. Your cash is being used for an asset that will have future value and also will generate future net income for your business. Your cash position at the end of the year is made up of cash items. So these are cash short-term investments, and they're often recorded on the balance sheet. So for a lot of first-time business owners, your cash will be the only line item on your balance sheet that says cash, and it will also be, the bank account that you use to maintain that cash from an operational perspective. Kind of the last key of the puzzle here is really the notes to the financial statements. And as I kind of said at the beginning of this presentation, the notes of the financial statements are really telling you the story behind the numbers that are on the face of the financial statements. They are an integral part of the statements, and usually you can have supporting schedules within the notes to the financial statements. So if you look at what exactly the supporting schedules might be, if you put together your income statement and all of a sudden you see a whole bunch of small dollar values that maybe make your income statement look cluttered, say, you can put a single line on your income statement that says operating expenses. However, you'll need to break down further what those operating expenses are made up of. So a lot of times you can see in the supporting schedules in the notes, you'll have a breakdown of exactly how you get to the operating expense line that is on your financial statements. Another key item is usually property, plant, and equipment. You'll have one line item for it on your balance sheet. And then when you go into the notes of the financial statements, a lot of times that's where you will find a breakdown of exactly what kind of assets you own. Do you own vehicles, equipment, technological assets? What exactly is it? With that, I don't have any more slides other than a Q&A slide to kind of, take any questions or concerns that you might have. But this is a very high level kind of understanding of exactly what kind of financial statements we'll deal with. So what we really looked at was your income statement, which will zero out every year, and it will tell you exactly how much revenue, how many expenses you had just in the year you're focusing on. Or if you create monthly financial statements, it will show you them on a month-by-month basis. Your balance sheet is showing you assets and liabilities, so any ownings that you have or owings that you have that will roll every single year based on your prior year closing balances. Your net income every year at the end of each fiscal year will close into your retained earnings, which is a key part of your balance sheet. So you need to do your income statement before you can finalize your balance sheet. Your statement of cash flows is an important schedule in making sure that all of your expenses are reconciled and all of your non-cash transactions are accounted for. And your notes to the financial statements are a key of kind of telling that story of exactly everything you might not have been able to convey on those first three statements. With that, I see we have a couple of questions in the Q&A box. So I will probably read those out loud, and then if I can answer them, I will. I have Peter with me here today. He's another manager at Deloitte, and he might field a couple of questions if maybe I can't, but I'm not sure if I foresee that. Josh, would you explain the financing option in detail? Absolutely. So the financing option let's hop back here. Financing is really cash received or repaid kind of throughout operations. So what a lot of times you'll see in kind of the financing here is any item that you have used to generate cash that is not specifically related to operations. So what we mean when we say operations is revenues and expenses that you've incurred that's a part of your business model. If you're selling technology, or if you're a tech company selling software, selling software is a direct increase in your revenue, and the expenses related to that are a part of your operations. However, if to develop that technology, you needed to get a bank loan for it, you needed to borrow money from yourself, a shareholder, if you needed to involve other shareholders to offer you money. So, let's say your brother gave you $10,000 to be a part of the business. He wanted a 20% ownership in your business. That would be considered a financing option. And what those really mean is any cash that you receive as a business is an increase in your financing option. And then any cash that you've paid back is a decrease in your financing cash. So a decrease in your financing cash would be things such as repaying a bank loan. If you're planning on buying out a shareholder, it would be any cash used to buy out those shareholders would be considered a financing option. And those are really what you'll find in the financing. There's not many other things other than cash uses or increases due to somebody investing or receiving loans for your business. I hope I did that one justice in answering. Okay, seeing none. Okay, perfect. It looks like I did answer that one appropriately. Thanks, Nita. I'll hop back down to the question slide here. Okay, hearing none.
Okay, it's looking like we don't have any more questions. Thanks so much, Josh, for the presentation today. And thank you to everyone else who joined us. As always, we'll be receiving an email from us tomorrow at this time with a link to watch the on-demand recording if you'd like to review some of the aspects today. And you'll also be able to find it directly on our small business resources page on our website. And if you're interested, don't forget to register for the rest of this series. The other two topics coming up are cash flow management and tax 101. So you can find more information about those on our website at wesk.ca/events. All right, goodbye everyone. Thank you for joining and have a great afternoon.
Thanks everyone.